Most investors don't lose money from picking the wrong coin. They lose money because they don't understand the market they're in. There's a huge difference between Bitcoin, crypto, tokens, and the broader ecosystem. And if you treat them the same, you're going to make the wrong decisions at the wrong time. So in this video, I'm going to break down the structure of the market, the key terminology, and the major pitfalls you need to avoid, so you can approach this with clarity instead of reacting to price. And most importantly, we'll finish with what almost nobody explains properly: what to do when volatility hits. Because that's where most investors fail, not at the entry, but in the reaction. In Part 1, we made the investor's case for why we should be investing in Bitcoin and crypto, currency debasement, the bond market, gold's limitations, the performance reality, and why the largest institutions in the world are already allocating. If you haven't watched that yet, start there. The link is on screen and in the description. In Part 2, we cover what exactly you are investing in and what is the language you must know. Welcome back to Bitcoin, Crypto, Gold, where we focus on the biggest wealth opportunities across Bitcoin, crypto, and gold using macro, technicals, and strategy. If you want that in a simple daily format, the free newsletter is linked below. It's a quick 5-minute read. Let's get into it. To understand the what, we must cover the crypto language, nuances, pitfalls, and landscape. This will give us an informed and balanced approach, because the investor who understands this makes very different decisions to the investor who is just following the price. By the end of this video, you will understand the landscape, the key concepts, the risks, and critically, how to manage them. We will close with something that most Bitcoin content never addresses properly: what to do when the inevitable volatility hits. And your response should be planned in advance, rather than reacting to panic, as many investors do. Why do we have Bitcoin? First, let's understand the problem Bitcoin was designed to solve. We go back to the global financial crisis of 2008. The global financial system was in free fall. Banks considered too big to fail were collapsing. Governments were printing trillions to prevent total collapse. Ordinary people lost their savings and homes, while the institutions that caused the crisis were rescued by the very system they broke. Then, on 31st October 2008, a 9-page document, the Bitcoin White Paper, proposed the creation of a new form of money that required no bank, no government, and no central authority. A system where the rules were enforced by mathematics, not institutions that could be corrupted or bailed out. This was a direct response to a monetary system that could not be trusted. Every feature of Bitcoin flows from that original purpose, and understanding that purpose tells you exactly what kind of asset you are dealing with. Before we go further, let's clear two misconceptions, because these are the two beliefs that stop most serious investors from ever engaging properly with Bitcoin. The first is that Bitcoin is a gamble, a purely speculative asset with no underlying logic. Part 1 covered why the macro argument supports Bitcoin adoption: currency debasement, fixed supply, institutional adoption. But social media is full of outrageous speculative forecasts. It's going to the moon. It's going to $1 million by year end. These comments reinforce the pure speculation misconception. Our approach is not based on sentiment. It is based on a logical, reasoned position that Bitcoin is structurally sound, macro-driven in its demand, and that scarcity will exponentially increase its store of value over time. The second misconception is that Bitcoin is too technical for non-technical investors. Blockchain, SHA-256, proof of work, forking, these terms immediately switch off investors who are not from a tech background. Here's our take. When you get in your car and drive off, you do not need to understand the internal combustion engine to get from A to B. When you invest in a tech stock like Google, you do not need to understand how search algorithms work on the internet. What you do need to understand is whether the asset has value and what its potential is, either as a store of value or as a growth asset. No different than how you would evaluate real estate, stocks, bonds, or gold. The terminology should not intimidate you. Bitcoin in simple terms. Bitcoin's two greatest features are that it's a decentralized digital asset with a fixed supply of 21 million coins. Let's break that down. Decentralized means there is no government control, no CEO, no headquarters, no single server to shut down. Bitcoin runs on a network of thousands of computers around the world that records every transaction on a global ledger that can be checked in real time. No one person or group can ever control it. Here is a practical advantage of decentralization. Governments around the world are currently developing central bank digital currencies, CBDCs. A CBDC is digital money issued and controlled directly by a central bank. It can be programmed. Spending can be restricted by category or geography. Accounts can be frozen at the government's discretion. Stablecoins, USDT and USDC, face similar risks. The private institutions behind them can freeze accounts, comply with sanctions, and restrict access on government instruction. With Bitcoin, none of that is possible. A Bitcoin transaction, properly executed, cannot be blocked by any government or institution on Earth. That is not a technology feature, that's an investor protection. In a world of increasing capital controls, sanctions, and financial surveillance, the difference between assets that can be controlled and assets that cannot is one of the most important distinctions any serious investor can make. Gold comes close, but gold can be physically confiscated. The US government just did that in 1933. Bitcoin cannot. The second huge advantage is Bitcoin's fixed supply of 21 million coins. Unlike fiat currencies, which can be printed in unlimited quantities by central banks, Bitcoin's supply is capped and immutable. Its issuance is predictable and not subject to political or economic manipulation. That absolute digital scarcity is what makes it a reliable long-term store of value and a hedge against inflation. Understanding the crypto landscape. When investors say they want exposure to crypto, most do not have a clear picture of what they are choosing between. The landscape contains 4 very different asset types, and treating them as interchangeable is one of the most expensive mistakes an investor can make. Bitcoin is the original, fixed supply of 21 million coins, designed purely as a decentralized store of value, the most liquid, the most institutionally adopted, the only one with a mathematically fixed supply. This is the asset that most closely resembles digital gold. All other cryptos are called altcoins, alternative coins to Bitcoin. They include Ethereum, Solana, Ripple, and thousands more. Each serves a different purpose. Ethereum is a platform for smart contracts and decentralized applications. Ripple serves as a bridge currency and settlement asset designed to facilitate fast, low-cost, real-time cross-border payments for financial institutions. Altcoins carry higher volatility than Bitcoin and are more susceptible to hype cycles and market manipulation. Some have genuine long-term utility and institutional backing. Many do not. They are technology bets, higher risk, higher potential return. Just as some tech stocks collapse and others rise dramatically, the same will happen across crypto. Think of it this way. We have the S&P 500 and the Dow Jones as leaderboards for top stocks. Crypto will have its own leaderboard of winners and losers. Most will fail. A few will generate extraordinary returns. Tokens are built on top of existing blockchains rather than having their own. They typically represent utility or governance rights within a specific platform. They rise and fall with the success of that specific project. For a beginner investor, this is not where to start. Stablecoins, USDT and USDC, are pegged to the US dollar and do not move in price. They are useful for trading and holding value within the crypto ecosystem, but as noted, they carry institutional control risk that Bitcoin does not. Essential infrastructure, not an investment. ETFs, BlackRock's IBIT and Fidelity's FBTC, allow you to gain exposure to Bitcoin's price through a regulated financial product in your existing brokerage account. No direct ownership, no custody responsibility. For investors who want Bitcoin exposure within a tax-advantaged account like an IRA or SIP, ETFs are often the most practical starting point. We cover this fully in Part 3. The summary: Bitcoin is for long-term wealth preservation and monetary sovereignty. Altcoins are higher-risk technology bets. Tokens are project-specific. Stablecoins are a trading and exchange tool. ETFs are the regulated access point. Know what you are buying before you buy it. Bitcoin dominance, the signal most investors never learn. Bitcoin dominance measures Bitcoin's market capitalization as a percentage of the total crypto market. It is one of the most useful indicators in the space and one of the least understood. When Bitcoin dominance is rising, capital is rotating into Bitcoin and away from altcoins. This typically happens in early bull markets or risk-off environments. Bitcoin is the place to be. When Bitcoin dominance is falling, capital is rotating from Bitcoin into altcoins. This is typically associated with the later stages of a bull market, what the market calls altcoin season. Higher risk, higher potential return, but closer to the eventual peak. A sharp decline in Bitcoin dominance often signals the start of an alt season, where smaller cryptocurrencies outperform Bitcoin. High Bitcoin dominance indicates that the market is dominated by safer, established capital. Low dominance suggests higher market speculation and risk. Tracking it helps investors understand when to transition between a Bitcoin-focused portfolio and one with greater altcoin exposure. We cover Bitcoin dominance as a practical portfolio management tool in Part 3. Bitcoin as digital gold. If you already hold gold or understand the case for it, you already understand a significant part of the Bitcoin thesis. Both are scarce, both exist outside the traditional financial system, both are driven by the same macro forces: dollar debasement, loss of confidence in monetary institutions, and the search for stores of value that governments cannot inflate away. The key differences. Gold has a 5,000-year track record. Bitcoin has been around for 15 years. Gold is physical, tangible, and familiar to central banks. Bitcoin is digital, transferable instantly anywhere in the world with no intermediary. Gold is more stable. Bitcoin is more volatile. But that volatility has historically produced significantly larger returns in bull markets. Gold is the anchor, stable, trusted, millennia-tested. Bitcoin is the asymmetric growth layer, higher risk, higher potential return, driven by the same forces as gold but with greater magnitude. They are complements, not alternatives. We build the combined portfolio in Part 3. What is the halving cycle and what every investor should know? Approximately every 4 years, the reward paid to Bitcoin miners for processing transactions is cut in half. This is called the halving. It directly reduces the rate of new Bitcoin supply entering the market. After the 2020 halving, Bitcoin rose from approximately $9,000 to nearly $69,000. After the 2024 halving, it reached its all-time high of $125,761 on 6 October 2025. But here is the important nuance. The impact of each halving is diminishing as Bitcoin matures. The market is becoming better at pricing in known supply events in advance. More significantly, Bitcoin's behavior during real-world stress events is changing. During the Iran conflict earlier this year, a genuine geopolitical shock that sent oil sharply higher and created significant market stress, Bitcoin barely moved. That is new behavior. It suggests Bitcoin is increasingly being treated as a store of value by sophisticated investors rather than a purely speculative instrument. The halving remains an important structural event, but it is one factor among many, not the only one. Understanding that volatility is a feature of Bitcoin. We want to present the facts as honestly as possible. Bitcoin can be volatile. It can have explosive rises, but it can also fall 30% in a week. If you're expecting smooth, steady returns, you're in the wrong asset. But here's the reframe. Volatility in Bitcoin is not a design flaw. It is the consequence of a young, fixed-supply monetary asset in the process of global price discovery. And it's the price of entry for the asymmetric returns Bitcoin has delivered over every meaningful time horizon. The investors who have made the most from Bitcoin are not the ones who timed every move. They are the ones who understood what they owned, held through the volatility without panic selling, and let time do the work. It's also worth noting that most of the most dramatic crashes are at least 10 years old and may not reflect Bitcoin's current level of adoption and maturity. Here are the most significant crashes in Bitcoin's history for context. June 2011, down 99%, triggered by the first major hack of Mt. Gox exchange. November 2013 to January 2015, down 86%, a long decline following Bitcoin's first surge above $1,000. December 2017 to December 2018, down 84%, the crash following the 2017 bubble. April 2013, down 83%, a flash crash caused by DDoS attacks on MT-Gox. November 2021 to November 2022, down 77%, triggered by rising interest rates and the collapse of FTX. March 2020, down 50% in 2 days, market panic at the onset of the COVID-19 pandemic. May 2021, down over 50%, China reinforced its crypto mining ban. Each of these crashes was followed by a full recovery and new all-time highs. That pattern does not guarantee future performance, but it is the historical record. For investors who want to be more proactive in managing that volatility and defending their gains, there's a more advanced approach worth understanding. Futures and options derivatives allow you to hedge existing Bitcoin positions. If you hold a meaningful Bitcoin allocation and want to protect against a sharp drawdown without selling your underlying position, you can use derivatives to hedge. Buying a put option gives you the right to sell Bitcoin at a specific price within a defined period, acting like an insurance policy on your position, allowing you to sell at the strike price even if the market price drops much lower. This is not a beginner's strategy. It requires understanding the instruments, the costs, and the risks involved. But for the investor with a growing Bitcoin position who wants to manage volatility more actively rather than simply holding through it, derivatives are the tool. We cover this in Part 3. The risks in owning Bitcoin and crypto and how to manage them. Every honest investment guide must address the risks clearly. Here are the 4 that matter most and what to do about each one. Regulatory and exchange risk. Bitcoin itself cannot be shut down. It's decentralized, but the exchanges that allow you to buy it and sell it can be regulated, restricted, or forced to close. FTX, once the second largest crypto exchange in the world, collapsed in 2022 with significant losses to customers who had left assets on the platform. How to manage it. Never leave significant Bitcoin or crypto holdings on an exchange. Move it to a personal wallet, a hardware wallet like Ledger or Trezor, where you control your own private keys. Your seed phrase, the 12 or 24-word recovery phrase, is the only key to your assets. Think of it like your ATM PIN number, except there's no bank to call if you lose it. Write it down on paper. Store it securely offline. Never photograph it, never store it digitally, and never share it with anyone. Own your keys. Own your Bitcoin. Lose your seed phrase and you have lost your Bitcoin. There is absolutely no way to recover it. Technology risk. The Bitcoin protocol itself has operated without a major security breach for over 15 years. The ecosystem around it, exchanges, wallets, DeFi platforms, carries more risk. Human error, software vulnerabilities, and phishing attacks have caused significant losses across the crypto space. The mitigation is the same. Control your own custody, use reputable platforms, and never click links in unsolicited messages claiming to be from a crypto platform. Exchange hacking is a real threat. If you've left your crypto on an exchange, you could wake up to find it is gone. The Japan carry trade and flash crashes. This is the one that catches most Bitcoin investors completely off guard, and most content never explains it. When the Bank of Japan raises interest rates, the yen carry trade unwinds. Investors who have borrowed cheaply in yen to invest in higher-yielding assets, including Bitcoin, are forced to sell those assets to repay their loans. The result is sudden, severe selling pressure across all risk assets simultaneously. Bitcoin, as a highly liquid global asset, takes some of the heaviest selling. This is why Bitcoin can fall 20 to 30% in days with no Bitcoin-specific news. The trigger is in Japan. The impact lands in Bitcoin. How to manage it. Watch the Bank of Japan. When BOJ rate decisions are approaching, and we cover these in our macro playlist, position your portfolio accordingly. For investors who want direct exposure to the Japanese monetary environment, Japanese equities and financial sector stocks can provide a complementary allocation that benefits when the BOJ tightens, partially offsetting the impact on Bitcoin. And for investors using derivatives, this is exactly the scenario where a put option hedge on your Bitcoin position earns its cost.
We covered the full BOJ thesis in a dedicated video on this channel, link in the description. What about a global internet failure? It's a question serious investors ask, and it deserves a straight answer. If every computer and server on Earth simultaneously failed, Bitcoin would become inaccessible. But so would every bank, every stock exchange, every payment system, every government database. The entire digital infrastructure of modern civilization would collapse simultaneously. In that scenario, Bitcoin is not your problem. Survival is your problem. The more realistic question is a prolonged regional or global internet outage, and here Bitcoin is more resilient than most people realize. Bitcoin does not require the entire internet. It requires enough nodes to remain connected to each other. Bitcoin has been transmitted via radio waves, satellite, and mesh networks entirely independent of the terrestrial internet. Blockstream satellite already broadcasts the Bitcoin blockchain from space. During regional outages in countries like Iran, Ethiopia, and Myanmar, Bitcoin continued operating globally because nodes outside the affected regions kept the network running. The important nuance for investors: a temporary internet outage would make Bitcoin temporarily inaccessible. You couldn't transact, but the blockchain itself, the record of who owns what, would be intact the moment connectivity restored. Your Bitcoin would still be yours. Bitcoin's decentralization means there is no single point of failure. In any realistic scenario between minor disruption and total civilization collapse, Bitcoin is more resilient than the centralized financial system it was designed to replace. So, that's now your part 2, the full investor's landscape for Bitcoin and crypto. You now have the origin story and understand what Bitcoin was built to solve. You can distinguish between Bitcoin, altcoins, tokens, stablecoins, and ETFs, and know what you're actually choosing between. You understand decentralization, why the CBDC comparison matters, and what Bitcoin domination is telling you about the market cycle. You know the halving cycle, the full volatility history in context, and critically, how to manage the risks through proper custody, market awareness, and for the more proactive investor, derivatives.
And as a bonus, 2 free downloads are released with Part 3, the Bitcoin and Crypto Investing Checklist and the Portfolio Allocation Calculator. Make sure you are subscribed so you don't miss it. Part 3 is the practical playbook, portfolio construction, buying strategy, wealth structuring, and the bigger picture that ties it all together. Before you go, join our free newsletter aimed at Bitcoin, crypto, and gold investors. The newsletter covers everything you need to know to make rational, balanced investment decisions in Bitcoin, crypto, and gold. It usually is a 5-minute read. The link is above and in the description. Subscribe to Bitcoin Capital Gold and hit the notification bell so you don't miss Part 2. Thank you for watching. We'll see you in the next video.